Happy Friday, everyone, and welcome back to Open Exchange TV. As you know, every Friday we sit here with Jay Pelosky. How are you, Jay?
Oh, I'm great, Scott. I mean, it's another one of those Fridays where it's like, thank God it's Friday, man, because again, challenging week in the markets.
Well, yes, it definitely has been challenging, but some people still seem to think it's summer out there. Maybe you, with your day trip going, checking out the beach. Run me through the title of your musings this week, Day Trip.
Well, I mean, scratching to come up with something a little bit different other than doom and gloom. So, yes, I actually admit to taking Wednesday off. I wanted to go to the beach. I haven't been all summer. I tried to get a few folks to go with me. Of course, no one bit. So I said, you know what, the heck with it. I'm going to go. So I went solo and out to my favorite spots, one of my favorite spots in the world, Fire Island, where I've spent, many summers as a younger man here in New York City. And it was just fantastic. I mean, as usual with these decisions, right? When you make a decision to do something like that, almost any kind of trip, it almost always is rewarding and fun. And this one was no different. We had, or I had smooth travel, fantastic weather. Wednesday was just an absolutely gorgeous day, blue sky, 80 plus degrees, no wind out at the beach, beautiful, cool ocean water. Had some great body surfing. I mean, I have to say, I am kind of a high quality body surfer and had some great rides. And the bonus was that my left knee, the surgically repaired one, held up fine in the surf. And so I got a nap in and then to cap it all off on the way back on the ferry ride back to the mainland, there was a big red fireball sunset, Mother Nature telling me to hurry on back. And then dinner with a buddy out at one of those famous Long Island red sauce joints. So what's not to love?
Well, very true. But I tell you what, there has not been a lot of love in the market this week.
That's why you got to do stuff like that, Scott. Otherwise, you get really depressed.
I can't be depressed. I'm speaking to fantastic people like you, other analysts, and so forth on the Nucleus 195 Open Exchange platform. Like, there's always great stuff to talk about, but there's a lot of stuff to talk about with you. And we always like to break down the tripolar world. And so what I'm going to start on this week is Asia,
Okay.
particularly China. In your musings, you have both bearish and bullish stories that have been highlighted in Bloomberg this week. Can you run us through those?
Yeah, I mean, I just thought it's quintessential in the environment that we're in. Bloomberg within it's got its five stories. When you punch up markets and punch up stocks or currencies, whatever, there are five little stories on the sidebar. This morning there were two China stories, one bullish and one bearish. I mean, one like growth is picking up because of the data overnight, which was actually pretty decent. Retail sales better than expected, fixed income, fixed investment better than expected, industrial sales better than expected. But the big story was the yuan falling below 7, breaking 7 for the first time in a couple of years. And of course, stocks sold off, right? Down 2% yesterday and down another 2% overnight. So, 4% type move in a matter of a day or two in China is newsworthy, but it's just this back and forth. Property was disappointing. Currency weakens a little bit, mostly because the interest rate differential. It's kind of interesting, right? The interest rate differential between China and the U.S. is the widest it's been in over a decade. So that's one of the things that's kind of pushing the currency relationship. Over in Europe, it's actually the opposite. The interest rate differential between the U.S. and Europe actually peaked about a month ago and has come in about 50 basis points, suggesting maybe some stability in the euro. Sorry, I know you wanted to talk about China, but I just think this interest rate differential, the dollar is key. We've been talking about that for a while, and the interest rate differentials are definitely driving some of the relationships there. In the case of China, that wide interest rate differential breaks the currency below 7 or above 7. And, that sets the market off in a negative tone, even though data point is getting better. China recovery is picking up. The big lockdown in Chengdu that everybody got freaked out about, they're already dismantling it 2 weeks in. This is not the China of 6 months ago where they locked down Shanghai for a couple of months and freaked everybody out. This big lockdown in Chengdu, which is a big city, 20 million type people city, is already being dismantled down 2 weeks. So China is getting a handle on dealing with COVID. And yet that news, as I say, as far as people are concerned today, there's nothing good in China. I would beg to differ.
Actually, I was at an international event yesterday, a lot of different investors, traders, and so forth, and no one wants to touch China. Everyone's very wary on China right now.
Yeah, but I mean, we do touch China. We're long China, both equity and debt, and we're long property. I mean, it's amazing. We have a Asia high yield ETF in our global multi-asset model, and it's got 30% of its exposure is China property. And guess what? Over the last month, it's been one of the top 5 performers in our global multi-asset model. Why? Because people are, as exactly as you say, nobody wants to touch it. They're all gone. Everybody's gone. And yet the economy is starting to pick up. We're going to get President Xi get his third term in a couple now, probably roughly just about a month from today, actually. And then I expect more policy action out of China. So, KWeb, which is the China Tech ETF, we also have a position in our global multi-asset model. That bottomed in April at $20. Look at it today. Even with all the bad news, it's at $27. It bottomed 4 months ago. People just are, I mean, it's a strange time. It's a tricky time, and people have no conviction. And so, they're not involved in China, as you say. At some point they will be, though. That's the point. At some point they will be. And when they are, things are going to move very quickly.
We touched on Europe there before, and we actually spoke a couple of weeks ago about how you called to get basically at the top of the gas prices in Europe. But there's a lot more going on in Europe, and you like Europe. You've said that over the last few weeks as well. But once again, there's a lot of other things, a lot of other people sitting on the other side of this argument with you as well. Argument's not the right word, but like theory.
Yeah.
Why do you love Europe so much?
Yeah, no, I'm definitely in the minority there for sure. And just point out that, I mean, you gave me the hat tip for the gas price peak, which we nailed. Look, it's down 45%. And Goldman Sachs and others are saying the gas price is going to fall another 50%. In other words, half again by the end of the winter, and then half again over the course of 2023. So that to me is constructive. And if we're looking to invest on a 6 to 12 month view, which we tend to be actually more like 12 to 24 months, then we should be pretty excited about what's likely to happen in Europe. Because if gas prices are going to fall like that, then will fall. And in the interim, you have record low unemployment, you have cashed up consumers, and yes, they've spent the post-COVID celebration. But you have the government stepping in with fiscal support to deal with the energy price, right? So consumers are going to be supported. That's pretty clear. One of the clear conclusions of the EU meetings about what to do about the energy issue. And so we're not as bearish as people are in terms of looking at recession. We think there could be recession in Europe. Not going to say it's impossible, but it's going to be mild. And by the way, the euro, according to the OECD, is at a record undervaluation of over 40% versus the US dollar. That should be supportive at some point. And in the interim, by the way, earnings revisions in Europe, as are in the case in the US, are turning up, and there are more companies guiding up than down. That doesn't fit the narrative. That doesn't fit the media story. That doesn't fit what most people are talking about. But if you're an equity investor and you're focused on earnings, which you should be, then the story is way better than what the headlines would suggest. And that's what we're banking on. Remember, our view, high nominal growth world supports the top side. Companies have pricing power. They've been focused on their margins on the cost side for the last 2 years, given COVID. That means margins are okay. So one of the firms, I think it's Bank of America, their 12-month for their earnings revision indicator suggests earnings growth on a global basis of 7% over the next 12 months. 7% plus a couple percent dividends, you're talking about close to a double-digit return versus cash at 2 or 3%. People love cash, but 10% beats 3% last time I checked.
Math is hard though. Math is very hard.
Yeah, no, definitely addition. I never got multiplication, actually.
All right, so let's move on to the US. And obviously, there was three letters that came out this week that scared the hell out of the market. CPI.
Classic. Look, Scott, classic. Buy the rumors, sell the news. Right? Stock market was up 4 days in a row before that data point came out. And yes, it was a little disappointing. People were primed, as they have been many, many times. And this inflation situation has been so disappointing to so many for so long, right? Because it's been like a year plus that the number has surprised to the upside. And so people were just like frothing at the mouth for that big drop, which then people will pile in and reverse all the trades that we saw over the last couple of days. But it doesn't happen. And so this time you had people very primed for a lower than expected number, and up 4 days in a row. Guess what? The number doesn't come in better than expected. It comes in slightly worse than expected. And bang, you get a 4% down day. But it only brought us back to where we were, 5 days before that. But 4% down in 1 day, I mean, nobody likes that unless you're mega short. And so for the most part, yeah, that hurts. But I mean, look, where we are, we have the Fed coming up next week. We have been and continue to be in the 75 basis point hike camp. The real question for us is that going to be the last of the big front-loaded 75 basis point moves? Because whenever that last big front-loading happens, we think that's going to send a signal to the dollar and lead to that dollar rollover, like we touched on earlier about the interest rate differentials, right? And so that's really the key for us. And we're in the camp where it's become a little less clear, right, given the inflation. But our view is Our view does continue to be that next week will be the last of the 75 basis points, and that should help shrink the interest rate differentials, because the ECB is going to be continuing to hike, as we know. We think the ECB will hike more than the Fed in 2023. And so that's going to reduce that undervaluation of the euro, reduce that interest rate differential with the US rate structure, and support the euro versus the dollar. And so that's one of the big themes of ours and a big focus point. The other point I would make, and I think it's really interesting, is that if you take the inflation prints we've had the last 2 months, which was 2 months ago was minus 0.1% month over month. This month it was plus 0.1% month over month. If you average those over the next 12 months, guess what? Inflation comes in, headline CPI will be below 4%. So in the 3% range by March of 2023, And that would suggest that the Fed's the Fed funds rate will likewise be under the PCE deflator, which is the Fed's preferred measure, not headline. But this is what people are not cottoning on to. If we continue at the same pace as we are now, headline inflation will be less than 4% by March. That is only 6 months away. And so to us, again, it signals that the time to be, bearish inflation, the time to be bearish rates, bearish stocks, bullish cash is coming to an end. And when that point occurs, I don't have a crystal ball. I wish I did. When it occurs, the reversal, I think, is just going to be absolutely tremendous.
Okay, well, there's also one other thing we haven't really brought up. Like, obviously, we mentioned briefly before earnings, but Fedex today, stock's down at 25%, its biggest drop in about 40 years. Is this something that maybe concerns you a little bit, to your theory? Is like we should be getting involved here? Like, this is big news, no?
Well, I mean, I think there's a lot happening. I'm just trying to look at my notes because I have some of these points highlighted. But I mean, obviously, it's a big stock. People are worried about earnings. That's the thing that's been propping up the market, so to speak, right? Because let's remember, real rates have gotten above 1%, the highest they've been in years. You've had a very aggressive tightening cycle. Financial conditions are now the tightest they've been in years, and yet the S&P still sits 6 or 7% above the lows of June. right? So things have materially gotten worse from the rate side and the financial condition side, and yet the S&P is still 6% above. So that's, so earnings are the difference there. Remember, we wrote a piece called Earnings Bridge now 2 months ago, getting ready for the next earning, for the last earnings cycle, arguing again, the high nominal growth world supports the top line, allows companies to have pricing power. That supports earnings, and earnings are what really drives stocks. And that's why we maintain a constructive approach to the markets currently, and really basically over the last 6 months or so, as painful as it has been, and it's been painful. And so now where are we? Well, look, the earnings revisions are, as I mentioned, turning up. The outlook for Q3, I believe consensus for the US is like 4%. We don't think 4% earnings growth for the US in Q3 year over year is a stretch, right? So let's always remember, we can't just take any one company, even one that's as widely involved with the economy as a FedEx, and say, okay, that is representative of the entire S&P 500. The entire S&P 500 earnings growth calls for 4%. That's the consensus. Earnings revisions continue to do okay. I mentioned Bank of America. Their earnings revision indicator globally suggests earnings growth of about 7% over the next year. So that's more what we look at, kind of broad data, not a single name incident like a FedEx, but it just reflects the world that we're in, right? Bad news sells, and people hit the sell tape. And again, as we wrote last week with Lines in the Sand, the title of our musings last week, the market went right to the 3850 level on the S&P, which is considered an important technical level, but went right to it within like the first 20 minutes, the first half hour of trading. And that's the kind of market we're in. We're being, played around by technical levels because the macro backdrop is so uncertain, right? You've got a bullish story and a bearish story on China and 5 stories on Bloomberg, and earnings are uncertain because we're not, yet there. But that's where we hang our hat. We continue to hang our hat on the idea that a high nominal growth world is earnings supportive. And look, Bank of America with their fund manager survey, just want to highlight a couple of points because I just thought it was just so amazing sentiment wise, right? Here we go. Three points to note. Record low risk appetite. Lower risk appetite than at the bottom in 2008. And as we've said before, we're not in anything like a 2008 environment. Okay, record high cash allocations, record low equity allocations, and a record long most crowded trade, i.e. the US dollar, the most crowded since long tech at the end of 2020. And so that's where the market is, right? So there's 2 things. There's the data, and then there's the positioning and sentiment and seasonality. Seasonality right now, arguably, this is the bad time for the market, right? The second half of September, first half of October. But outside of that, you can't get, these are all record numbers for B of A. I think they've been running these surveys for 20 years. Record high cash, record low risk appetite, record low equity allocations. What are you going to do with that? I think you've got to kind of take the other side, particularly if you believe that earnings are going to be okay, as we do. And that's where we sit. After a day at the beach, I feel better. I encourage, you to do the same. If not the beach, out there in the country this weekend, but, get away from the desk a little bit, get away from the screen. It's healthy.
There's just so much to read and so much to watch, and we provide a lot of it to you.
Yeah, no, you do, but your eyeballs will fall out of your head at some point there, my friend.
No, you're 100% right. You do need to take a break every now and again. I'm glad you did. And next week you're traveling, so we won't have you back for Friday musings.
Yeah, I'm going to be down at Duke, hoping cheering on those Blue Devils tomorrow. So hopefully we go 3-0.
Well, good luck with that, Jay. And we look forward to having you back in a couple of weeks, okay?
All right, buddy. Take care, Scott.
And for everyone else watching, good luck investing.